Quantitative investing is an implementation methodology more than a strategy itself. And so I would consider the two different implementation methodologies discretionary investing or quantitative investing.
If you are watching this video, then you probably want to know more about the famous secret clubs of investment, hedge funds. Join us for the ride as we explain everything you need to know about them. While modern hedge funds are a lot less secretive than they used to be in the past, the theme still draws plenty of attention. Originally only available to the cream of the crop among billionaires, hedge funds have changed considerably in recent years. We will go through the basics on what hedge funds are, how they work, and what makes them so unique compared to other investment options. 1. What are hedge funds? Hedge funds are, in simple terms, pooled private investment funds run by highly specialized managers. The idea of hedge funds isn't exactly new and goes all the way back to 1949. Alfred Winslow Jones, an Australia-born American sociologist, came up with the concept and also created the first hedge fund. Jones raised $100,000 from multiple rich investors. As the name suggests, the concept was initially based on hedging investments. In other words, hedge fund managers would usually invest in competing assets to ensure that they would be able to profit in any situation. Early hedge funds essentially followed a relatively simple long-short strategy, which consisted in going long on one asset and then shorting another similar asset. By doing this and hedging their bets, these funds could make up for market fluctuations and ensure an absolute return, regardless of the economic scenario. Basically, hedge funds stick to the two golden rules of investing. The first one is to never lose money, and the second rule is to never forget about the first one. That being said, because of their risk-taking disposition and aggressive strategies, hedge funds do have a chance of going under with one wrong move and dragging a disproportionate amount of assets with them. So, you shouldn't invest in a hedge fund on a whim. Hedge funds saw significant growth in the 1990s thanks to a booming stock market. By the time of the 2008 financial crisis, hedge funds had already surpassed the $1 trillion mark. Initially, hedge funds were aimed at a very select group of investors, mainly billionaires and millionaires. With high fees and minimum investment requirements often in the six figures, hedge funds soon became a sort of secret club. Because of their restrictive nature, hedge funds ascended to an almost mythical status. But in reality, they are nothing more than investment funds that try to maximize returns with a variety of aggressive risk-taking strategies. With the sheer amount of money involved, early hedge funds did have the ability to manipulate the market. This is part of the reason why they continue to be a hot topic for conspiracy theorists. But such episodes of hedge funds manipulating the market became increasingly rare, as the market also continued to change and adapt to this new reality. There were zero occurrences of hedge funds willingly manipulating the market over the past 15 years or so. Outside of the odd conspiracy theory here and there, hedge funds nowadays continue to quietly coexist with other investments. And even though they continue to hold a disproportionate amount of financial assets, they no longer have the market-altering powers from early. 2. How do hedge funds work? As we just mentioned, hedge funds aren't that different from regular investment funds. Just like any other investment, hedge funds have one goal, and that is to make money. One major difference is that hedge funds operate in a sort of gray area and have to deal with fewer restrictions compared to conventional investments. While most countries require hedge fund managers to have some kind of registration, that's usually about as far as regulations go. For the most part, hedge funds can operate under their own rules without having too many reporting requirements. Because of this, hedge fund managers enjoy a lot more freedom, which means that they also require a large amount of liquid assets at their disposal. Hedge fund managers deal with a lot of money and carry a lot of responsibility. It's no surprise that they get paid handsomely for their work. Since hedge funds were initially aimed at a very select group of investors, and also because of the lack of regulations, these funds also charge well above the market average. In general, hedge funds follow the 2-20 rule, a 2% annual fee based on the fund's net value, and a 20% fee based on the increase in the fund's value over the year. Initially, hedge funds based their strategies on their managers' investing acumen. Modern funds have taken full advantage of technology and rely on advanced mathematical models, as well as AI, to carefully plan their moves. It's worth mentioning that hedge funds are no longer the restrictive secret club from the past. In fact, most funds have largely diversified their clients. Pension funds, insurance companies, and even universities now make up a large percentage of hedge fund investors. And even us, common folk, can also gain exposure to hedge funds by investing in funds of funds. 3 types of hedge funds. As mentioned at the start of the video, early hedge funds followed a simple, long-short model known as equity funds. Over time, hedge funds evolved and adopted new strategies. Aside from equity funds, hedge funds are usually split into another 4 categories: global macro, event-driven, relative value, and directional. Global macro funds make their moves according to geopolitical developments. These funds often acquire a high number of assets in anticipation of a huge market shift based on global events such as climatic events, conflicts, and sanctions, to name a few. Event-driven funds take advantage of discrepancies in the market that can happen during corporate events. In simple terms, the market can either undervalue or overvalue assets whenever a major corporate process happens: bankruptcies, mergers or acquisitions, liquidations, among others. And when that happens, event funds make their moves to profit off these price differences before the market goes back to normal. Relative value funds make their investments by comparing the value of similar assets. For example, these funds can acquire an asset at a certain market for a lower price and then resell that same asset for a profit in another market. Another strategy is taking advantage of arbitrage opportunities within the same stock market, expecting the prices of these assets to converge at some point. In other words, funds take advantage of price discrepancies in multiple markets to make a profit. Directional funds are based on analyzing market trends and predicting eventual shifts. If an asset's price rises well above the historic average for its respective market, funds can acquire a short position and wait for the price to fall. Likewise, if an asset suddenly becomes undervalued compared to its historic average, funds can acquire a long position and wait for the price to rise again. Of course, this comes with some substantial risk, since a wrong prediction could lead to major losses. And now you know what hedge funds actually are and how they work. Did you find this video helpful? Then don't forget to tell us in the comments. Wealth Enriched is your channel for all things finance. Like, subscribe, and turn on notifications so you don't miss out on our content. See you in our next video.